If you're a non-US partnership which keeps its financial statements in the local currency and you need to file tax returns with the US, you should be aware that the Internal Revenue Service can only accept tax returns expressed in US dollars. Therefore, a currency conversion would be needed in order to report your financial activity in US dollars. When converting financial statements, it is important to pay close attention to which part is actually being converted. For example, the balance sheet and the profit and loss statement will be converted using different exchange rates. Generally, two rates are used. The first is what's called the average rate, and the second is what's known as the spot rate. The average rate is literally an average of the conversion rates between two time periods. The spot rate is more precise. It represents the exact exchange rate at a specific moment in time. In preparing tax returns, you're typically working with a balance sheet as of the end of your fiscal year. The balance sheet is normally segregated into three components: assets, liabilities, and equity. Assets and liabilities are mainly converted at the fiscal year-end spot rate. In other words, for a calendar year taxpayer, you would use the spot rate as of December 31st. When converting fixed assets, there are two ways that taxpayers can accomplish this. One is to convert the cost and accumulated depreciation at the same spot rate as all other assets. The other is to convert those items based upon historical costs so that the conversion reflects the date the items were placed into service. Equity deviates from the normal conversion rules that apply to assets and liabilities. When converting contributions or distributions, you should be using the historical conversion rate that corresponds with the date on which the contribution or distribution occurred. For example, if you were converting balance sheet items at a December 31st spot rate, but a contribution to the partnership occurred on July 1st, the contribution would be converted at the July 1st spot rate. Unlike the balance sheet, an income statement offers an overview of everything that occurred throughout the fiscal year. An account on the income statement is much more dynamic in nature, as it tracks the financial movement from the beginning of the year to the end. Therefore, the income statement is normally converted using the average exchange rate for the entire year. This is a real time saver too, as it would be tedious to have to track the conversion rate for every item that goes into every account on the income statement when it actually occurred. Being that the balance sheet and the profit and loss statement are converted using separate exchange rates, there will often be an adjustment made to the equity section to take into account this difference. If you have questions about how currency conversions work, contact your Untracht Early advisors for more information. I'm Maria Scala with Untracht Early.